All right. So last week when we met, we had a very preliminary discussion about the law of demand, and we discussed the factors, the determinants which have a strong impact on the demand for anything, any good or service. Um, and then we also discussed about the reason behind the law of demand is that there is an income effect and then there is a substitution effect. Um, if you can put your mics on mute, that'll be great. Um, one correction I want to make, in the lecture recording last week, when I was listening to myself, I happened to said that the General Theory of Employment, Interest and Money, the book written by J.M. Keynes, was written in 1776. It's factually incorrect. In 1776, the book Wealth of Nations was written by Adam Smith, who is called father of economics. But then in 1936, in the last century, in the 20th century, 1936, this book called General Theory of Employment, Interest and Money was written by J.M. Keynes, John Maynard Keynes, who is not called father of economics, but he's definitely called father of macroeconomics, the broad economics, like GDP, national income, inflation, these kind of phenomena. So that's one correction, please do it. We carry on, and the thing I want to start with today is the movement along and the shifts in demand curve. I hope you can see the movement of cursor on the screen. I hope you can, yeah? Can you? Can somebody confirm that you can see
Yes,
that
we can.
I'm moving the
Yes,
cursor?
yes.
Very good. That's very important that you can see the cursor is moving. Otherwise, I have to draw those pictures, but it's better that you can see the cursor. There's a movement along the demand curve, and then there is a shift in the demand curve. It's very important to understand that what is movement and what is the shift in the demand curve. In this picture, you can see that I'm measuring the price of a commodity. It could be X commodity. The price of X commodity is on the vertical axis, on the Y axis, and the quantity of X commodity is measured on the X axis or the horizontal axis. And if you focus only on the blue line, don't see anything else, just the blue line, it confirms the law of demand. It says that ceteris paribus, other things being equal, there is an inverse relationship between price and demand. In other words, if the price is up, the quantity demanded is low. And if price goes down, even though this is not written in any alphabet, but if the price drops, the quantity demanded will rise. On the contrary, if the price is low, the quantity demanded is more, but if price goes up, the quantity demanded contracts, shrinks, decreases, falls. And this phenomenon is called law of demand. But the very important thing is the starting word which I used, ceteris paribus, the other things being equal. So in this blue line, my assumption is that the only thing which varies is the price. The income is, remember the slide? The determinants of good X. So only price of X is changing, the taste are constant, the number and the price of substitutes and complementary goods are constant, income is constant, distribution of income is constant, there's no change in the expectation, there's no change in the population, there's no technological development or degradation, and there's no other change in any other factor except one factor, that is price of X. If we only draw the relationship between price and demand and we happen to assume that everything else is constant, then we have this type of line, the blue line. This is called the movement along the demand curve. So the demand can be less, demand can be more, depending upon the level of price. But the key thing, the key message I want to deliver you is that there's no change in any other factor except for the change in the price of the good we are talking about. And then you see here the red line, yeah? So you can see the arrow. So it looks that the demand curve has shifted rightwards. Now, see what happens. When the demand curve shifts, this is purely because of the other factors. When the price of X doesn't change, price doesn't cause any change, price doesn't become a cause, but the price becomes the effect. But all other factors, any of these factors can change. They can all change, or even one of them or two of them can change. But the most important thing is that the price of X doesn't change. When all other factors, one or all so-called other factors, when they change, there is a shift in the demand curve. For instance, look at the price P. When the population increases, at the same price, there'll be more mouth to feed, more people who would demand. When the income increases, you start consuming more, because earlier at a given price, when your income was low, you were very miserly, very thrifty kind of spending pattern you had. Your consumption was very low level. Maybe you were not able to afford it at a given price because your income was very low. But when the income increases, you get a hike in your pay package. Now you don't have to buy food. You don't have to remain semi-starved. You can buy more. And when at the same price, the quantity demanded increases. So see here, OQ0 to OQ1. And look, the price is same. You become richer. Or maybe the government give you tax incentive and you have a lot of extra saving now, and that saving you can spend on consumption. So the message I'm trying to deliver is that when the price doesn't change, but because of the other factors, the demand increases, then this is called the shift in the demand curve. So you can see that at the same price, there is an increase in the demand, right? So this is called the movement along the demand curve. When there's a movement along the demand curve, it's purely because of the price of the commodity in question. But when there is a shift in the demand curve, then the price of the commodity have no role to play. It remains static, but all other factors, or one of them or two of them, depending upon the circumstances, but some non-price factor makes a change, and because of that, your demand can increase or decrease. For instance, you're quite affluent, you're quite rich, and you had a lot of income, and you were able to consume more when the income was high. But when the income drops, then you are able to afford less at the same price. So therefore, it's very important for us to make this kind of conclusion that when there is an increase in demand, there can be movement along the demand curve, or there can be a movement, there could be shift in the demand curve itself. Okay, so shifting of the demand curve, when you are all together at a new demand curve, this only happens when the price of the commodity in question doesn't change, but some other factors make this kind of shift. So there is a shift in the demand curve. So you are able to consume more at the same price. Yeah. I hope it's clear.
Yeah.
Okay. And then we move on to the supply schedule. Now here, it's very important that when you discuss about the supply, you don't think from the consumer's point of view. You think from the sellers, producers, manufacturers' point of view. Okay, so you have to see from a different perspective. So the supply schedule shows that the different quantity of good that producers are willing and able to supply at the various prices over a time period. So you can see here is that there are price of potatoes in pence, and then the farmer supply per kilo is yeah, and then there is a supply, and you can see here that as the price increases, the supply increases. So if I'm a farmer, if I'm a supplier, if I'm a producer, if I'm a miner, if I'm a manufacturer, if I'm a processor, if I'm a service provider, as the price increases, it will be an incentive to me to supply more because this is the right time to get more revenue and more profits. So there seems to be, unlike the demand, there seems to be a positive or a direct or unidirectional relationship. I mean, they move together. Yeah. So when the price increases, the supply also increases. And if the supply for one farmer or one supplier increases, and then there are more people, so you can combine them, and thus you can have the market supply curve. And as you can see that, it slopes upwards, which means that as the price increases, price is the cause, and the supply, quantity supplied, is the impact, is the effect, a consequence, and this also increases. The supply curve could be a straight line, depending upon the data available, or it could be a curve. If it is a curve, it will still be like a convex to the origin, like this, if I can draw this way, I hope. But before I move to the next point of discussion, I want to get some convincing arguments from you people that why do supply increases as the price goes up? I said something that it's an incentive, it's a motivation, but I deliberately didn't explain much. So I want you to say a bit more that what could be a rationale, what could be a reasoning, you being as a producer, as a supplier, feeling motivated to supply more when the price increases. So I want to hear from you something. Yeah, please go ahead. So my basic question to you is that why do supply increases when the price increases?
Well, if you take, for example, these potatoes as an example, I would be trying to grow more potatoes when I see the price of potatoes are going up. So I would be seeing my chance there to earn more money, basically. That would be my motivation to grow more. So of course my supply would be going up.
So it's a motivation. See more from the business point of view. See more from the calculation point of view. Obviously, when you are a supplier of potato and you hear the news that, hey, the price has gone up, so how your calculations get affected, how your numbers changes.
Perhaps, yeah.
Try to visualize a situation.
The demand. Yeah.
Sorry, go ahead. Yeah.
Do you hear me?
I hear you.
Okay. Did you want to say anything?
No, but go ahead, I said. Go ahead.
Okay. There is something with my internet connection. So, if the yes, that the demand goes up also. And if it's so, we will get all the potatoes sold which increases our profits.
Well, if we talk about supply of anything, uh, the product is already available, because in the short, price can change every minute, every hour, but the supply doesn't. The overall quantity is fixed. The rest of the quantity could be in your warehouse, could be in your the refrigerator or somewhere else. But the point I'm trying to make here is that when the price increases, your cost doesn't change. In the short period, your cost doesn't change. Your cost remains same, because the potatoes have been manufactured. They have been not manufactured. The potatoes have been grown already. They have been produced already. They are lying somewhere. You as a supplier is controlling the release of the supply. So you know that the cost of growing potatoes have been incurred. The only cost you are incurring now is the storage cost, which you have. But otherwise, potato as such has been grown already. Okay, you have paid for the labor, you have paid for all of the costs which are essential to grow potatoes. Now, when the price goes up, your cost remains constant, but your potential revenue increases. And what is called the gap between revenue and cost? That is called profit. So the gap between the revenue and cost widens with the increase in the price. Because given the cost, for the given cost, your revenue is likely to increase with the increase in the price of the commodity. And for the same cost, you are able to get more revenue. And the gap between the revenue and the cost, that is the price, is widening. Now imagine the cost of production of the potato is 17 pence and the price is 20. Okay, it means that the profit per kilo is 3 pence. Now when the price moves to 40, then what happens is that the gap between 40 and 17 is 23. The profit per kilo is 23 pence. And as the price goes up, the gap between the revenue and the cost increases, the price and the cost. And that motivates you to supply more, because now you know that before the situation reverse and you are not able to get that much of leverage, that much of profit, before the situation happens, you supply more. So then you are able to provide more of the supply. Okay. You can ask me that, what if the cost increases? If the cost increases, then you have the loss and you never supply at the loss. Well, you can supply, but in many circumstances, the supplier, the producers choose not to supply at all when the price is below a certain price. You can see in the figure here, in this picture here, that when the price is below 20, supply is 0. Your supply curve is not starting from the origin. You can see here, the line doesn't start from 0. Your supply curve is not like this. Your supply curve always starts from certain point, and that point is 20 pence. Now, 20 pence means that if the price is 20 pence per kilo, there will be 100 kilos or 100 tons, whatever, potatoes would be supplied. But if the price is below 20, then supply would become 0. The farmer choose not to supply at all. So it means that there is a bottom line price, there is a threshold price, there is a minimum reserve price. This word is very important, the minimum reserve price. The farmer knows that by all means, he must get 20 pence per kilo. And if the market price is below 20, then I would choose not to supply at all. Worst come worst, the potatoes would rot. Okay, all right, I'll throw it. It happens many times that the producers, the manufacturers, they rather destroy their production at a very low price rather than selling it, because they are not able to cover their cost at all. So I know in many countries, the farmers, when they don't get the price of the choice or the price they expect genuinely to be received, when they don't get it, they rather destroy the product than selling it at a very low price. Because if they start selling at the low price, their market bargain goes down, and then sets a wrong example in the future that, hey, they people have no choice but to sell even at a very low price. So it's a matter of the bargaining strength. The farmers, in order to keep their bargaining strength intact in the market, they prefer to sell, they prefer not to sell if the price is below a minimum threshold price. So 20 cent is something which the farmers not should but must receive. And any price below 20 pence is unacceptable to the farmer and or the producers or supplier, whosoever, and the supply becomes zero. Because if they keep supplying even at a low price, then the supply curve should start almost from zero. And if the supplier do like that, then they are giving up their bargaining strength. Remember, consumer is concerned with the demand. The seller, the buyer is concerned with the demand, and the seller is concerned with the supply. And these are the opposite forces. They basically are competing in the market. Producer would think that he or she should get the maximum price. The buyer would be dreaming of paying the minimum price. So the mindset, the perceptions about the price are absolutely opposite for the producer and the consumer. And therefore, there is some kind of competition between them. This is why we call that it's a competitive economy. It's a competitive market, because the buyer and sellers are competing against each other, not in an unhealthy manner, just because their aspirations are different from one another. Okay, you saw the picture before that the consumer like to buy more when the price is less. On the other hand, the supplier would be willing to supply less when the price is less. So the notion of price. So price is the one determinant which brings buyer and seller together. Okay, so this is how the supply work. We need to know some of the determinants of supply, the factors which have an impact on the supply. Of course, the price of good is a very important factor. Higher the price, more would be the supply. We discussed about it. Cost of production. When there is a change in the input price, wage, raw material, rent, interest, let's say it clear and loud. When the input become expensive, let's say let's talk about the potatoes. When the fertilizers become expensive, I hope I can see it. You can still see it. Yeah. When the fertilizers become expensive, when the wage rises, when the interest rises, so then the reserve price will not be 20 pence. It will go up then. Because then at 20 pence, the seller is not able to afford selling, because he is not able to cover his cost. So when the cost increases, the supply price not start from 20, but at the higher level. The profitability of good in joint supply. Sometimes the products are supplied jointly. For example, when you are growing sugarcane, I don't know if you have seen the sugarcane farm, but the sugarcane helps to produce sugar, of course. But another byproduct which remains, which you can call it almost a waste of sugarcane, is that the waste of sugarcane can be sold to the distilleries, the breweries, where they make these alcoholic drinks. All right, so it means that the one crop is able to serve two purposes. The sugarcane is same, that is helping the production of sugar, but that also used as an input in the alcohol industry. Now, what happened is that when the price of alcohol will increase, then this works as an incentive to the farmer to grow more sugarcane, even though the price of sugar doesn't rise much, because he knows that the waste of the sugarcane can be sold to the distillery or to the brewery where they are making the alcohol. So it also depends on the profitability of the goods in joint supply. There are many crops, there are many products you can see, especially in the agriculture sector, where the product is one, but its supplier are multiple. So people use this thing for different purposes, and that also have an impact. The nature of random shocks could be also if there is the climate in the country, if the political climate in the country is uncertain, there is a probability that there are elections around the corner, and there's a high chance that the government which will come in the power would not be very helpful to the producers. The government is very kind of anti businesses. In that case, the supplier, before the election results come, will already start cutting down the supply of the product, because they know that if they produce a lot, they have to keep the extra inventory in the warehouse. And by the time elections are held, and if their fear comes true, and the party who comes in power is anti-businesses, they would put a lot of taxes on their products. And therefore, they will not be able to cover the cost. And therefore, they might have to destroy the products, or just they have to bear the inventory cost, because after all, the storage can be very expensive. So in the first place, the producer choose to cut down the supply already in anticipation of those things. Similarly, there are aims of producers also. Some producers are more profit-centric. Some producers are more market-centric. Some producers are even willing to accept low prices if they want to make their inroads, not indoors, if they're able to make their way in some new markets. So they know that if they want to win the new market, and they have to compete against the existing titans in the market, then they have to compete with them. And in order to compete with them, they need to lower the price. And therefore, you will notice that many companies, they are almost monopolist in their home country. They charge more price to the domestic consumers. But when the same company goes to the international trade, then they are not monopolist. And if they want to compete against the different sellers, they have to lower the price. And sometimes the price is even below the cost, because they know that even if they're having a loss in the global market, but they're still making their presence felt. And whatever the loss they're making in the international market, they can recover from the domestic market. Okay, this is also called, in the extreme form, this is called dumping. Dumping, when you are really selling cheaper in the international market, because you want to erase your competitors, you want to change the whole dimension of the game, but then you're charging more price from your local consumer so that you are able to remain financially sustainable. So the aims of the producers are also very important. And then you are having the expectations of the future price. If I expect that, if I'm a seller and I expect that in the future the price will go up, not now, but in the future price will go up, then I would not release my supply. I will keep it blocked, because I know that in the future, if my expectation turns true, then I would be able to get more revenue from the same. But if I feel that in the future things are not going to go well, the prices will fall, the market would be in recession, and I have a lot of inventory in my warehouse, then I would rather do this clearance sale. You see, very often you see that there's some sales by some shops, and very often they write that something like closing down sale, something like that, which means that maybe they're able to close down and they just want to get rid of everything. So they are selling exceptionally cheaper. So the future price expectation play a big role. If in the future you think the sales, the price will go up, then you are able to hold the supply now and you rather postpone the sales. But if you have very pessimistic expectation about the price, it will go down, then you rather sell now than in the future. And also the number of suppliers is very important. If you are living, this point is actually I have covered already in point 5, that if there are more suppliers, then the market is more competitive, all right? Then you are not able to supply more at a given price because you are competing against. But when you have less suppliers, the market is more like oligopolistic. Oligopoly is a market form when there are very few suppliers, not many. You can see there are many industries like oil industry, automobile industry. Maybe these kind of industry require huge amount of investment, and it also require a huge technological infrastructure. And they are under very strict regulation of the state. And because of these things, not small entrepreneurs can venture into these businesses. So in such circumstances, only very strong, big companies are remaining in the market. And because they're very few, we call them oligopoly. And if there are exactly 2 suppliers, we call it duopoly. And if there's only 1 supplier, we call it monopoly. And of course, monopoly is good for the seller's point of view, because then there's no competition and you can have a lot of control over the price. But as you move away from monopoly and then you go to duopoly, then oligopoly, and then there is a perfect competition when you have large number of suppliers. So when you have more suppliers, then you have a less control over the price, and thus you are not able to change your sales much because of the stiff competition. So therefore, the companies always look for those markets which are fresh, which are unexplored, and where they can sell the products with comparatively less fear of competition. So these are some of the determinants of the supply. And as I said, that